The majority of people who invest in mutual funds do not make adequate returns on their investments. There are a couple of reasons why this is the case. The first and major reason for not making adequate returns on your mutual fund investments is that people allow their emotions to interfere with their investment decisions. They do not have a clear process as to what they want to achieve with their mutual fund investments. And as a consequence, they are always reacting to the ups and the downs of the market. Typically, after a bear trend, the majority of investors are sitting in cash because they do not want to lose any money. The market then begins to turn up, as it did in March 2009, and most mutual fund investors do not believe that the new bull phase has occurred. They continue to sit in cash, not wanting to risk their funds. Normally, once the market has moved at least 50% of the move, the investors have decided that they are losing out and that it is now time for them to get into the market, because they must now make money and everybody else is making money. Without a plan, they do not know what sector of the market they want to invest into. They do not know what particular mutual fund they want to invest into. They do not have a clear time horizon for their investment. They do not have a goal or objective for their investment. They do not know whether they wish to get capital appreciation or whether they wish to draw an income from their investment. Without all of these questions being answered, what the new investor does is he scans his newspaper and he looks for the mutual fund which is currently giving the best return, or mutual fund which is in the top quartile. And he makes his investment decisions from these top performing mutual funds. History tells us that funds which are in the top quartile today, more than likely and in most cases, will not be in the top quartile in a year's time. So not only is the investor investing once 50% of the move has occurred, he's also investing into mutual funds which are not necessarily the correct mutual funds for him and his circumstances. So now the investor is in the market, and after some period of time, and we never know what period of time that is going to be, it could be months, that period of time could also be years, the market now begins to move down. And he's beginning to take a little bit of a loss, and the value of his investment is beginning to drop. But since he is an expert, he believes that the market is now in actual fact going to turn around. Not too long away, the market will turn around and continue in its bull trend. He continues to sit because he doesn't have a plan of action, he doesn't know where he's going, and eventually, once the bear phase has moved again, about 50 to 75%, the pain is so great, the embarrassment is so great, that our new investor decides to exit his mutual fund investment. If he is lucky, he has made a small return on this investment, but in the majority of cases, he has exited the investment at a loss. And this could all have been avoided had he had a clear plan in mind, instead of reacting to the ups and the downs of the market. Most mutual fund investors, if they do make money, most of them do in actual fact not beat the market, because they are attempting to time the market, they are attempting to get in at the bottom and get out at the top, and what in actual fact ends up happening is most investors enter the market at the top and exit the market at the bottom. This is totally the opposite way to what should be happening. In order to avoid these problems and make sure that you have an investment which is earning a return above the rate of inflation, and that needs to be your first target, you need to know a couple of things that need to be put in place for your mutual fund investment to be a successful investment. Number one, you need to know what the term of that investment needs to be. You then need to select sectors in the mutual fund industry which are appropriate to that investment term. If your investment term, for example, is only a year or 2 years or 3 years, you need to select appropriate sectors and therefore appropriate mutual funds which match the term of your investment. If your investment is of a longer duration, 5 years, 7 years, and 10 years, you need to select sectors and therefore mutual funds that are suitable for that particular term. The longer the term, the more risk you can take, because even in the event of the market correcting, you're not needing to access your investment at this point in time. You've got the luxury of being able to wait for the market to recover. And being in the market for a longer period of time allows you to be in a position where you can earn decent returns. History tells us that if you're invested in an equity market for a year, you have something like a 25% chance of losing your money. However, if you are invested in the market for a 10-year period, based on a rolling 10-year period, there is no chance that you are going to lose your money. That's obviously not a guarantee, but that has been the performance of the market in the past. So, to wrap up, you need to know what the term of your investment is. You need a goal, you need an objective, you need to know which sectors you're going to invest into, you need to know which mutual funds you're going to invest into. And you actually need to stick to your plan. Do not exit and enter the market based on volatility over which you have no control. The only aspect you have control over in your investment is sticking to the plan, irrespective of the noise that is in the market. Thank you.